All right. Was having some technical difficulties with my headset. Let me know if you can hear me, Jessica. Waiting for confirm on that. Or if anybody just wants to write to me, let me know if you can hear me. Never know if this thing works. All right, I think you guys can hear me. Someone has raised their hand, so if we can't, then we will find out soon enough. But let's get cooking on here. So I'd like to welcome all of you. I know you're all participating in your company 401k plan, and so I'm the financial advisor, Dan Romero, that I'm here as a resource for you. So one of the educational tools that we offer are these presentations to give you an update of what's going on with the markets, and also essentially some ideas, some tax planning ideas as we head into tax season here that you might be able to take back with you. So let's jump on in here. I know your time is valuable. Get this cooking. Knowledge is power. So the more informed you are as a plan participant, the more likely you are to achieve your goals and such. So we want to make sure we're available to you. We're focusing on the retirement planning when we talk about a 401k plan, but preserving assets, tax planning, estate planning, investment planning are all things that go into financial planning. So if you're an individual that has needs beyond your retirement plan, feel free to reach out to us and we can definitely help you with some things. So let's dig into this thing. 2021, and you may not remember this, but the very first trading day of 2022, when we came out of that, was a good day for investors. The Dow Jones jumped more than 200 points, which closed at a record start. That was day one. And then the rest of the year happened. So in 2022, we saw one of the worst crashes since 2008, with the market being down nearly 20%. And by the market, we're talking about the S&P 500. Now, when we put that into perspective, you can see over the long term here that we've had various pullbacks. We're still on a nice trajectory, and it's always just something important for you to consider here is that when you look at investments, the long term is what you want to look at, but it's not like we haven't been here before. So what were the things that caused so much disruption? It's going to be inflation, rising interest rates. We had a slow economic growth, weakening of fiscal and monetary stimulus, and some global unrest. We're going to go over all of those here. So let's start off here just to, again, see specifically with the market. The three major indexes had one of their worst years in a while, basically since 2008. The Dow Jones was the best of the lot, down about 9%. S&P 500 down about 19. It's a broader index in our opinion. And then, of course, the NASDAQ, which was down 33%. A lot of the tech-heavy stuff really got punched in the face last year. Now, when we look at the year as a whole, you can see these various ups and downs throughout the course of the year. When we look at the fourth quarter, it started to rebound a little bit. You can see the green arrow kind of point up, even though there was a little bit of pain at the very last month there. Since the end of September, we've seen a little bit of a rally. So that's certainly helpful for you. So the other issue that we dealt with was inflation. The Fed really saw this coming in an aggressive manner. So we were as high as a 9.1 inflation rate in June. Now that's been dropping. The latest numbers we've seen are 6.5%. We may see a uptick when the next report comes out based on some of the things that we're reading, but not necessarily sure about that. But as a whole, we've seen the inflation numbers head in the right way. Now, it may not necessarily feel like that when you go to fill up your tank or you go to the grocery store. A lot of stuff still feels very, very expensive. And so that is going to be a little bit of a headache as we deal with the stock market. Now, because inflation has gone up so much, the Fed has decided we are going to attack this by raising interest rates. We want to make the cost of money more expensive. It's not as readily available, in the hopes that it drives prices down. So we've seen one of the fastest, if not the fastest, rate hike in some time. So the year started off with a 0% interest, when we're looking at the Fed, we were at a rate of 0%, and it's gotten up to basically 4.25 to 4.5 at the end of 2022. Now, they have raised rates a quarter of a point at the beginning of this year. The target is looking closer to 4.25 to 4.5%. So we do expect the Fed to continue to raise interest rates. Now, this is something to consider with regards to bonds. When you have a bond, there's an inverse relationship as it pertains to the interest rate and the price of the bond. So think of it this way. If you have a $1,000 bond, let's say you bought a 10-year treasury bond last year, and that rate was at 1%. Now the Fed raises rates aggressively, and it gets up to 4%. Well, if you wanted to sell that bond that's paying 1%, you're not going to find anybody that wants to buy it because they'd prefer to buy one that's paying 4% right now. So if you really needed to sell it, you would have to discount it. So when rates went up, the value of the bond falls. So that's why you have that inverse relationship. On the flip side, if interest rates drop and you have that 4% bond and they go back down to 1, now everybody's going to want your 4% bond. So you'll be able to get a premium on that. You'll be able to sell it for more. So that's how bonds basically work. Now, always remember, when you buy a bond, if you buy it at its price, let's say you buy it at $1,000 bond, and it's a 10-year bond, when you get to the end of that term, you do get your money back unless the company or the municipality defaults. But when we're talking about government bonds and things like that, it hasn't happened in the U.S. for a U.S. Treasury bond. So, but bonds do have that risk where it could default. But ultimately, at the end of the day, when you hear that rates are going up, expect to see the prices of your bonds go down. So that caused additional headaches last year that go beyond the stock market. Now let's look at those Treasury yields. When we look back at last year, you can see that 5-year, 10-year, they were both under 1%. 20 and 30-year, 1.4, 1.6, very, very, very light interest rates. But now we're at 3.9, 3.88, 4.14, 3.97. So you can see if you own this 10-year bond, and last year it's at 0.93 and now it's at 3.88, you're going to feel a lot of pain. You would have if you were in intermediate to long-term bonds. Now, we might be towards the end of that. Again, the Feds, we're almost getting closer to the target rate of the Fed, but I do expect them to continue to raise rates as long as inflation remains high. So we will continue to do these every few months so you can keep up to speed on it and see where things are at. You may have money in the bank. Watch out for that. A lot of the banks have very low interest rates. You can do much better than that. So check out high savings numbers. You can find some good savings numbers in the range of 3.5 to 4%. But a lot of money markets, if you don't do anything at the bank, will still be pretty low. So we are at a much better place. You want to proceed with caution. That's our advice here as well. Things could continue to be bumpy, and we'll take a look at what we think is coming on going forward. Now, with that said, there have been good numbers when we're following a recession, when the stock market returns after a recession. I don't necessarily know if we're in a recession yet. It looks like we may be headed towards that, towards the end of this year. Even though the Fed is raising rates, there are signals in the bond market that say that the Fed may start lowering rates at the end of this year. So we'll have to see what happens. But you can see once we're past the recession, you can see there's been some pretty good stock market returns after that. So it plays into the portion where if you have money in the market, you always want to consider a long-term perspective. So our outlook is that we expect interest rates to continue to hike. If you are borrowing money, it certainly has become more costly. If you want to buy a house and you need to get a loan, it's far more expensive. You'll want to review all your income-producing investments. And then, of course, practice patience and focus on the long term, particularly with your stock market investments. So some takeaways for you is that we think the bear market could continue here. Revisit your budget and determine what is necessary versus your discretionary purchases. I would imagine that folks are spending less now that you go to the grocery store and it's so expensive. Make sure you have a well-devised plan. We do offer our participants in our plans a needs analysis to kind of see where you are with regards to retirement, and there is no additional cost for that. And just remember, we are here for you. We are a resource for you. Short-term goals, long-term goals, it's important to know the difference here. When we're talking about retirement, it generally leans on the long-term side. A short-term goal might be something like buying a house in the next year, a car, something like that. You want to invest it a little bit different. So let's move on to the next thought and some proactive tax planning ideas that may or may not help you all, but some things that are some good ideas for you. So let's start off by looking at what the rates are. So the tax rates are going to remain the same. These are the same rates that were put in place under the Trump administration. There were attempts to change them the last couple of years, but the administration was not able to. So they're pretty favorable for most people here. So these are the rates that we're seeing for single filers, married, so on and so forth. The long-term capital gains rate also is going to remain the same. This does not apply to money inside of your 401k plan. Anytime you buy and sell within your plan, you do not have to deal with any of the taxes. The only time you deal with taxes inside of your plan is when you're pulling money out. But aside from that, if you have assets outside of your 401k plan, you can see there is a 0% capital gains rate. So you can see if that applies to you. Most people fall in the 15% capital gains rate. And then, of course, higher earners are going to be in the 20% rate. Keep in mind that your states also have their own rules as it pertains to capital gains. So that's just something for you to consider. Now, for those of you, obviously, we're in dealing with 401k plans. This is a very important slide right here. The maximum amount you can put in your 401k has gone up. So you can now get that first line there shows 22,500 is what you can get inside of the 401k. If you're over 50, there is an additional 7,500 catch-up that you can get as well. So if you're under 50, you can get 22,500. If you're over 50, it's 30,000. These other plans wouldn't necessarily apply to you. Defined contribution plan, simple SEPs, things like that are a little bit different things. But if you have spouses or other people that have access to other plans, those limits have gone up as well. For those of you that receive gifts or are giving gifts, the gift exemption amount has gone up to $17,000 per person. Let's dig into that Secure Act 2.0. For those of you that have been at the RMD age, it was 70 and a half. So if you own an IRA or 401k, when you got to 70 and a half, the government wanted you to start pulling that out. Secure Act 1.0 raised it to 72, and this most recent Secure Act raised it to 73. Now, keep in mind, if you're a participant in the 401k plan and you are working, you do not have to take an RMD unless you own 5% or more of a company. So that is just something to note, that you don't have to take it if you're working there. If you have a 401k from an old company, you would have to take those RMDs. It's only for the company you're currently working at. Also, in the Secure Act 2.0, some of the penalties were reduced. There used to be a 50% penalty if you did not take that RMD. That's going to be reduced to 25%. And if it's actually corrected in a timely manner, that will be a 10% penalty. And if anybody has any questions, there's a Q&A at the top. Go ahead and type those in there. And when I get to the end of the presentation here, I will answer those questions for you. Now, this here is a QCD for RMD. So those of you that are at the RMD age, if you don't need those assets, you have the ability to take that RMD and put it into a charity, which will permit you to potentially avoid taxes on that. You'll want to talk to your CPA and your tax professional to make sure that works. But if you don't need to take the RMD, you don't need that money, there are ways that you can limit your taxes on that. Now, for those of you that are in simple plans or SEP plans, there is the option for a Roth opportunity there. So a Roth is essentially you pay the taxes now, and then you get a tax-free benefit at some point when you start taking it out in the future. You have to be over 59 and a half at that point. So see us with questions. This is a really interesting item that has come from 2.0. There is provisions in here that you may be able to move money that's in a college 529 plan. 529 plan is a plan that you use to save for college for your children or grandchildren. You don't get any tax discounts from the feds. You might get some from the state, depending what state you're in. But you save that money, and if you used it for a qualified purpose, some sort of educational that fits the list, then that money comes out tax-free. If you have leftover money in there, they are now looking at within the year 2024 that you could convert that. There are provisions. You have to hold the assets for 15 years. You still have to stay in line with the annual contributions to a Roth, and there's a lifetime limit of $35,000. But it is a really neat way for you to go about it, and this has to go into the benefit. It has to go to that Roth IRA for the beneficiary. So this is a really neat provision that was added. So keep up on that. If you're interested, send me an email. This applies to some folks, but it has to do with Roth conversions. And essentially what we're looking at here is, when does it make the most sense? So if you have money that's in an IRA or a 401k that you do not need and you want to get it off to your family, we've got this labeled as family tax bracket management. So we're looking at the family as a whole. It might make sense to convert the Roth if you are in a lower tax bracket than the folks you're going to get it to, your children, pay the taxes now so that they get the money and don't have to pay at their bracket. But if you are in a higher bracket than who the assets would go to, then perhaps maybe you don't want to convert it to a Roth. So this could apply to your parents as well. If they have assets that they're going to eventually be getting to you, then maybe it does make sense for them to convert now, but maybe it doesn't. So the benefits of a Roth conversion is that it does lower your taxable income over the long term, because you do get tax-free income when you start taking it out after 59.5. You don't have to worry about required minimum distributions. They don't force you to take it out when you get to 73. And then when it does get to your beneficiaries, the withdrawals will be tax-free. Most 401k plans that we work with, we do have a Roth option. So you can actually put your paycheck into the Roth rather than the 401k. Again, that's something you probably want to talk to your tax professional before you go about doing that. For those of you that are charitably inclined, a donor advised fund is for a way for you to get maybe some assets, some stocks that you have that have a very low cost basis, maybe get them into a donor advised fund, which ultimately goes to charity. So this is a way where you can bunch contributions and then and over the course of time get them to various charities that you want. So this is, if you're interested in that, let us know. Now, we did talk about the qualified charitable distributions earlier. Even though the RMD has been pushed to 73, we still can do this at 70.5, which is the old RMD age. Again, kind of what we're doing this for is to help you be a little bit proactive rather than reactive. So I want to thank you for being on this. We do plan on doing a little more involved tax presentation. So keep up on our website. We're putting our events on the website now, and that is romerowm.com. So feel free to keep an eye on that. This, of course, is our compliance. It's important for you to know everything that we've got going on there, where we got this information. So I'll let you guys take a look at this for a minute. But I do want to thank you all for attending the presentation. Let me see. I do see a Q&A on here. So let's see what we got going here. Okay, for equities, what trends do you see in the sector rotation for 2023? In 2022, we saw a rotation out of technology into energy and healthcare. What is your guidance for the best performing sector this year? Well, right now, what we're seeing is a big move back into technology to start this year. That the areas that were hit the hardest last year have really done well to start the year. Now, do I think that is going to continue? That's really tough to say. That sector is really dependent on what happens in interest rates. So we have been seeing bond rates drop, even though the Fed has been raising rates, and the technology sector has been responding in a good way. But if we do start to see inflation go back up again, then you could see a little bit more pain as it pertains to some of these tech stocks again. So we're continuing to be cautious right now. We do have technology in our managed portfolios, and we're leaning towards things that maybe are a little bit more blue chip in nature, even some technology companies that are paying dividends. Energy looks good, industrials look good. So there are areas that still continue to look good out there, but I'm still saying a diversified portfolio is going to make a lot of sense for folks, and really continue to be cautious, because a lot of the issues that were around in 2022 still exist today. It's quirky when I see the inflation numbers come out as they are. It doesn't feel like what they're telling us. When I go to the store, it seems like it's been as expensive as ever. The gas station is expensive as ever. So if we run into those things again, then we could have some problems. And again, we're really waiting to see if we do wind up in a full-blown recession towards the end of this year. So that's kind of what we got there. Any other questions? Okay, great. We post our newsletter. We get that up on our website, so feel free to take a look at that. And if you know any participants in your plans that you feel might benefit from this, again, just tell your plan sponsor that you enjoyed this and you'd like to hear more of these. Our goal is to do this at least 3 times a year to give you an early year, a mid-year, and a year-end update. So feel free to get that going. If you have any additional questions, you can email me. My email is dan.romero, R-O-M-E-R-O, @lpl.com. You can also go to my website and you can just do contact us and ask any questions, and then we can help you out at any time. All right. I hope everybody has a great day, and thanks for joining us. Take care.